Robert, let's bring you in on this because I think that's a great place to start a conversation about private equity, because without that credit creation and the ability to leverage, that inevitably suggests that this halcyon period of private equity deal making where we saw ever larger numbers in the headlines is over.
I'm not sure that's true. I think what you're going to see is a reversion to fundamentals and a focus on what really matters to people, which is, do the numbers stack up? In the past, you've had banks financing things because they knew they could sell them off in the securitization market. And what's happened is that securitization market has very much gone away now. It's gone. It may come back. It will come back at some point. But for a while, it's going to be gone. And so what people have to look at is deals. Are they very comfortable doing them? Are the banks comfortable doing the deals and holding that debt on their balance sheet, knowing that there may not be an exit for it? And for a long time, they haven't had that.
But that takes the financial player out of the market at this point, doesn't it? I mean, a trade buyer can step up if they can demonstrate reasonably deep pockets to be involved in the deal, but the leverage is gone.
I think there's still the leverage is there for the right deals. I think there's still a market, absolutely, because now is a tremendous time to be in the private equity business. If you take a look historically, I've been in this business since 1989, and if you take a look historically where funds have made the best returns, it has always been in markets like this when asset prices are cheap and you really have to look at the best deals. And right now, it is a great time to be in private equity.
Robert, if I can just jump in. You've been in this business 19 years, and doesn't the industry, whether it's the banks or whether it's private equity, don't they owe an apology? I don't expect an apology, but really they do owe an apology to pretty much everyone out there who relies on the global economy, because what they've done under the premise of saying, well, we're doing these deals so that we can get efficient capital situations at these companies, efficient balance sheets. You aren't geared up enough. They sold us this mantra, just like the analysts tried to sell us EBITDA in the dot-com boom. They sold us this idea that if a company wasn't geared up to the hilt, it wasn't capitally efficient, and hence they've got a lot of responsibility for the problem we've got now.
Well, I don't think we want to oversimplify this. I think the role of private equity is to take companies that could be better managed or where there's an opportunity and add capital to grow that opportunity. And oftentimes private equity firms come in and they grow companies very successfully. If you take a look historically at private equity companies, they tend to perform better, ones that are bought by private equity, than ones that are publicly listed. And so that's got to tell you something about it. This isn't a new market. Private equity has been around for a very long time. It's just more in the news now.
But the point is, yes, you're right, there is a large tranche of traditional private equity activity, which I'm sure, as I say, from 1989 onwards, was a bread and butter of the industry. And then there was this new mantra that came about, as I say, this extra gearing, this we've got to securitize everything, we've got to gear these companies up to the hill. That's the bit, that's the froth that's come, and hopefully will just go away again, and we'll be left with an industry, as you say, that does create jobs, that does grow businesses, that does create efficient businesses. This over-gearing lark is what we've all got a problem with, isn't it?
Well, I think your point is very good, which is some private equity firms have relied only on financial engineering to be successful, and that is frankly not a sustainable business model in this market. But ones that do approach businesses from a fundamental business improvement point of view, improving productivity, getting more out of the business, growing it, expanding it, that is a market that's always going to be there, and that's something we're very comfortable with.
Two questions. One is, if assets are so cheap and private equity pockets are so big, why haven't there been any deals done? I look at my market and I think, hang on, if it's such a great idea, why is nobody doing any deals? The second question, which is the flip side of that, is where do you go now for an exit? The equity market's pretty much shut. You can't re-leverage that company to take some cash out of it because the banks won't lend you in the same multiples that they did before. So how do you, from a private equity point of view, get an exit in the next 24 months?
Well, I think if you're looking for an exit in the next 24 months, maybe that's not the right thing. But you have to remember, private equity is a long-term game. It's not something you're in for a year or 2 years. Private equity funds are 10-year vehicles. And 10 years from now, if you're comfortable saying there's no exits, then I don't think anybody should be in the private equity business. But I think, you know what? Companies are going to have to exit. Maybe they'll have to do it differently. The IPO market will open up again. It's just a matter of time. Maybe a while, but you know what? If these companies are fundamentally well managed, then they should be comfortable. People should be comfortable investing in. And if there's a longer hold period for a company, that's sometimes the way it is. You have to wait for the right exit, not You can't time the market sometimes.
We come back to the first question. Why no deals? Why has no deals been done at the moment?
Well, I think you're seeing very few high-profile deals. And the reason you're seeing very, very few high-profile deals is because, and smaller deals are definitely happening, but those don't make the papers. Nobody reads about those. The big high-profile deals aren't happening right now because the big syndicated debt market is closed. And it's going to reopen at some point, and it'll make the news. But right now, there just isn't enough firepower in banks to go out and lend to these things. That's why you're seeing problems.
Louise.
Is there a big difference between the medium-sized deals and the smaller deals? And I'm ruling out the big deals on purpose, because that's where we're seeing the drying up, right?
Yeah.
I mean, so the small size and the medium-sized deals. I mean, where are you seeing the most activity now? And
well, I think we're seeing activity across the board. There will always be activity because there are guys who are in private equity firms who are paid to be out there looking at deals and doing deals. So there's always going to be activity. Whether deals close is going to be a financial matter, and it's really a question of do the numbers stack up and does this make sense. In the small and medium-sized market, you have many more people who go after deals that really require fundamental restructuring and growth. There's less management talent in smaller companies than there are in larger companies. Larger companies, generally big buyouts, rely on financial structuring. That was the case 20 years ago, 10 years ago, and it's still the case. So as long as that financial engineering market is somewhat closed, which it is now, you need fundamental improvement in the companies.
What are we going to learn over the next month or so as the essentially the report cards come back from a lot of these private equity companies on the businesses that they've managed through the last year or so? Are they going to be able to show and demonstrate that their involvement with the management teams have wrought significant benefits and value for the businesses? Or are we going to learn actually that the leverage that they've built into these companies is going to sink many of the businesses that they came into and got involved with?
Well, I think looking over the next month, it's private equity is a long-term game. So over the next month,
but there are a lot of investors who want to know what they've got for their money that they've put into the funds.
Yeah,
and this is the time when the KKRs and all these other companies are going to start having to report that.
Yeah.
So money is not long term. Money is short term.
Yeah, but in private equity, actually, it's long term. It's committed for 10 years. But I'll get back to your question, which is what's going to happen. I think investors are going to start asking questions about what's going on, and I think bit by bit, though, over time, the market will move on, and it'll be fun.
Robert, I think there's another reason why deals aren't getting done, and correct me if I'm wrong, I think they're worried about the exit route, and I think what Merrill's did yesterday in Debenhams shows to me that the exit route is very tortuous as well, knocking stock out down to 60 pence in a stock that floated at 195, not even telling your private equity partners that you were doing this deal.
Yeah.
There's a lot of pain out there still, isn't it? And I think they're worried about the exit route.
I think you're right, and I think also another thing which is crucial right now, which is that the term in the business is nobody wants to catch a falling knife. Nobody knows how far value is going to fall, and everybody wants to buy at the bottom of the market, not before it bottoms out. And so people are looking at the market saying, gee, that's a fantastic deal, but it would be even better 10% cheaper. So that's what people are looking at now, and that's another reason why you haven't seen a lot of deals, because people are saying, maybe there's better opportunity for me 3 months from now.
Robert, we've got to let you go, but thanks very much for coming in and fielding the questions. Robert Bibo joining us, partner at